Hi, everyone. Welcome to our live event today. Thank you so much for joining us. My name is John, and I'm your host from the Questrade education team. Joining me shortly is our very special guest. But before we get started, let's quickly go through a few details about Questrade for our guest joining us for the first time and cover some important event details as well. At Questrade, we care about Canadians' financial success. We offer better, simple, more affordable ways to take control of your money. And here's our agenda for today's event. After we cover the information about Questrade, we're going to move right into a quick introduction for our speaker, and we'll be joined by Fred Vettese for the main event, who's going to walk us through his Rule of 30 and other popular retirement strategies. Lastly, we'll wrap up with a live Q&A period near the end of the webinar today. So Questrade is one of Canada's fastest growing and largest independent online brokerages, and we've been a trusted name in the market since 1999 as the leading low-cost broker that helps put more money in your pocket. We have over $30 billion in assets under administration and open over 250,000 accounts per year. We also go above and beyond to protect your account with an additional $10 million in private insurance. Many different investment type accounts are available at Questrade, including both self-directed accounts where you can manage your own investments to buy stocks and other assets. And in addition, we also offer fully managed Quest Wealth portfolios through Questrade Wealth Management that are more of a set it and forget it solution. No matter what your preferences are, both self-directed and Quest Wealth portfolios are available in many account types, including RRSPs, TFSAs, RESPs, and much more. We offer zero commissions when buying exchange-traded funds known as ETFs, and on average, our commissions are half of what the Big Five banks charge for trading stocks and other investments. And to set us apart even further, all of our accounts support dual currency investing in both Canadian and US dollars. This means we won't force you to constantly convert back and forth to trade like some other institutions, thus saving you even more money over time. We offer many different types of investments within your accounts, including stocks, bonds, exchange-traded funds, and mutual funds, option contracts, precious metals, and much more. And for our newer investors, we offer hundreds of help articles, blog posts, and videos that can help get you started. And if you ever need a hand, our award-winning customer service team is there to assist through live chat or on the phone. We're here to help you take hold of tomorrow. All right, so moving on to some quick notes before we get started with the main event. Today's session will be recorded and we'll have the on-demand version available early next week. If you have to duck out or if you'd like to rewatch an important section, we've got you covered. Keep an eye on your email inbox for the recording. And if you have any questions during the presentation, please type them into the Q&A window available at the bottom of the Zoom interface. Our agents can help answer simple questions throughout the presentation, and we'll be hosting a longer question and answer period at the end. And if you're having technical issues or have general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. And here's our quick disclaimer. Please remember that the information conveyed in this webinar is for informational educational purposes only and does not constitute advice or recommendations by Questrade. All right, now moving on. Now, without further ado, I'd like to introduce our special guest speaker today. Meet Fred Vettese, a leading expert on retirement and financial planning. As a former Chief Actuary at Morneau Shepell and a best-selling author with over 100 articles published in the Globe and Mail and National Post, Fred has spent his career helping Canadians prepare for a financially successful retirement. He's written 4 books on the subject, including best-selling Retirement Income for Life and The Rule of 30, and he serves on the Retirement Advisory Board at Purpose Investments. We're very excited to have him here today to present, so without further ado, I'd like to pass things off for the main event. Thanks again, Fred, and take it away.
Great, thank you for that, John. And we're going to go straight to the presentation. Okay, so the ideas I'll be presenting over the next 45 minutes or so are based on my book, The Rule of 30. The audience for this would be, well, really anybody saving for retirement, any Canadian saving for retirement, but especially people under age 50. I have another book, Retirement Income for Life, which is really for people who are much closer to retirement. And what I'm going to be covering is it's going to be lessons from the past. I'm going to be giving my ideas on how people ought to be saving for retirement in Canada. This is generally people who are saving through RRSPs, TFSAs, also defined contribution pension plans. I have to say it's maybe a little bit less relevant for people who are covered by a defined benefit pension plan, which have become quite rare in the private sector. They're still common in the public sector. So that's kind of it. So there's 2 sections to this, lessons from the past. I figure we can learn what's going to happen in the future, or at least get some insights into it based upon what's happened in the past. And I'm actually going to start with some of the punchline. If you start saving in your early 30s, say, and plan to retire sometime in your 60s, the rule of thumb used to be that you have to save about 10% a year. I think it's now become about 12% a year because real interest rates have gone down. And if you really want to retire young, like sometime in your late 50s, for example, or you start a bit later, then maybe that 12% should be more like 15%. Now, I'm also going to be explaining as to why a flat 12% or a flat 15% doesn't work. But let's start with that and we'll go from there. In order to illustrate my ideas, I'm going to be using a young couple. He called them Brett and Megan. They are in their early 30s and they're both working, middle income. Between the two of them, they're earning just a little over $100,000. They bought a house, which probably you can't do with just a little over $100,000 in Toronto or Vancouver these days. But in my illustration, they've just bought a house and are making mortgage payments on that. And they will have a couple of kids eventually, actually in the next few years. So this is my couple. And so they're asking themselves the question, how do I save for retirement? So in the book, The Rule of 30, I actually illustrate all the ideas by having Brett and Megan talking to a next door neighbor who happens to be a retired actuary called Jim. So that's the way I actually unfold the story. So they ask, Brett and Megan are asking Jim, how much money should they be saving? And Jim doesn't give them a straight answer. He tells them we have to build up the story piece by piece. So I'm going to be releasing that story now, and I'll be doing it in the form of lessons, major lessons from the past. So the first lesson would be prepared for surprises. And this chart here shows kind of what I mean. You might think, well, if I save so much, and then how much am I going to have at retirement? It's hard to answer that question because we don't know what the average real return is going to be. So I'm going to just describe a few terms along the way. By real return, I mean your investment return over and above inflation. So if your return in a given year is 7% and inflation is 3%, your real return is 4%. And talk about a 60-40 asset mix. That's 60% stocks, 40% bonds. So here, this chart is a fairly complicated one. Each one of those bars in the chart represents a 30-year period. So let's look at the very first one in the chart. So that's when it says 1967. It is saying that if you were investing over the period from 1938 to 1967 and in a 60-40 mix, your average real return over that period would be 5%. And then you can see it just goes all over the map from there. The best ever would have been around the year 2006 or so, when the average real return over 30-year periods was 7%, and that was a wonderful time to be coming to retirement. Ironically, it's also around the time when people were talking about us having a retirement crisis in Canada. Things were probably never so good as they were then. The worst time ever to retire in Canada would have been 1975, when the average real return was about 2.7% over that 30-year period. The reason why that happened is actually kind of echoes with what's happening right now. We had gone from a period of fairly low inflation to high inflation, and that was because of the oil price shocks in the early 70s. And so with the high inflation, real returns really plummeted. There was a couple of years of terrible stock market performance in 73 and 74. And once again, as I say, that kind of echoes what's going on right now. So that kind of shows what's happened in the past. And the question is, what can we expect in future? I would say we're not going to have those same kind of high real returns in future as we had in the past, simply because what made that possible, years like the 7% in 2005, 2006, what made that possible were interest rates were coming down. And interest rates now are low, even in spite of what's happened in the past 2 years. They're still low, and they are not going to be repeating the same pattern they had over the last 40 years. So I'm saying the next 30 years is probably going to be closer to what happened in in periods ending in, say, the 1970s versus what's happened in periods ending in 2005. So as I mentioned, the worst ever was 1946 to 1975, when the return was just 2.6%. We're going to use this in our illustration. We're going to say, let's assume for the sake of argument that the investment scenario over the next 30 years is going to be matching the lowest, what we saw in the past 30 years, with a return of 2.6%. I'm going to show that even though that was the worst ever period, and maybe won't be quite that bad in future, you can still have saved enough money to retire well in the future without killing yourself in saving. So lesson number 2 is Understand Canada Pension Plan. That's what I call CPP. That's Quebec Pension Plan for Quebecers in the audience. And Old Age Security, OAS. These are the 2 government sponsored programs that provide pensions to retirees. And the CPP today pays a pension of 25% of income if you always had been contributing at the maximum level to the plan and we were retiring at age 65. It paid about 25% of income. Now that's for somebody who's earning the average wage in Canada, which is about $65,000. If your wage was closer to 80,000, then part of your earnings are not covered, and then the amount the CPP pays, it's capped because of that dollar cap. It ends up being about 20% of your income. So that's kind of what you would expect to get from before CPP expansion. That's shown here in this chart with the blue bars. For somebody who's always earning, say, more like 80,000 in today's dollars, so about 20% more than the average wage, they would expect about 20% of their to get a retirement pension from the CPP of about 20% of their final pay. Now, this chart shows also the yellow bars too. And what is that? So the Canada Pension Plan started changing in 2019. That's when contributions started going up. In 2020, for the first time, the formula started to change. This is because a little earlier, the finance ministers in Canada decided that they were going to expand the program with the idea that the 25% for an average wage earner was eventually going to rise all the way up to 33%. So the Canada Pension Plan would just pay that much more. The bad news is that this is going to take 40 years to happen. Good news is a large part of this audience is actually pretty young, and they'll actually benefit from most of that increase. So it means that if you actually wait 40 years, somebody turning 65 in 40 years' time, if they're earning $80,000, again in today's dollars, they'll get 30% of income from the CPP as opposed to the current 20%. And this chart shows just how it's going to be rising over time. The yellow bar is the part due to the expansion. Now, what's happening, and this is going to surprise some people, but the old age security OAS pension will be shrinking in terms of the average wage. And this might be surprising because you might think, well, OAS, it's fully indexed to inflation, and it is. And it's going to be staying fully indexed to inflation. I really have no doubt about that for the foreseeable future. Now, but why is it shrinking? Well, that's because wages go up faster than price inflation, than CPI. Not every year, but generally that tends to. Like over the last 90 years, wages have risen faster than price inflation by about 1% per year. That's going to be happening even more so in future. My guess is that because of what's happening with the worker to retiree ratio, there's fewer workers relative to every retiree than there used to be. And this trend is going to continue for the next 25 years. As a result, workers are going to become more and more precious. And I think they can expect to get higher average wage increases relative to inflation than we've seen, say, over the past 25 years. And so this is going to happen. So wages are going to go up. And because OAS is only going up as fast as price inflation, it means that as a percentage of the average wage, it's going to be coming down. So currently, it's about just a little over 10% of the average wage. And I think it's going to be falling over the next 30, 40 years to below 8% of the average wage. That's overall, if you add up both CPP and OAS, though, you're still going to be getting a pretty good increase in pension from those government programs. Now, some of you might be wondering, well, will those programs be around for me when I retire in 20 or 30 or even 40 years? I think they will be. In fact, I'm almost sure of it. Certainly with respect to Canada Pension Plan. The thing to realize with the CPP is that it's paid for fully by employees and employers. It's not paid for by the government at all. It's fully funded by the employees and employers. What the government does is they oversee the program, and their actuaries make sure that the program is going to be staying solvent. They stress test it in every which way imaginable under the worst of inflation, the worst of investment returns, and also demographics. And they've signed off on the idea that it's going to be totally solvent over the next 75 years and beyond. I have no doubt that the Canada Pension Plan will be giving essentially what they're giving today, plus the expansion over the next 75 years, and that nobody on this call needs to worry about whether the Canada Pension Plan will be there for them when they retire. Old age security maybe is a little bit different. Old age security is funded for by the government, and we've already seen at least one foray, maybe two actually, by the government to cut down on the OAS benefit, because as they say, they're paying for it, or we taxpayers are. The first happened about 30 years ago when they introduced a clawback. That was a conservative government, and they, if you earn too much money, in today's dollars, it's over more than $80,000. They start clawing back your old age security. That clawback is going to stay in place, but it's only if your retirement income per individual is more than 80,000 per couple, 160,000. So it has a fairly minor impact for most people in retirement. The other thing that happened was Stephen Harper's government, close to 10 years ago now, actually announced that they were going to be changing the starting age for OAS from 65 to 67. Then the Trudeau government reversed that, so it's still 65. I'd say there's a really good chance that one of these days the starting age will become 67. That's not devastating for retirees. Yes, it does remove a couple of years of income, but it's fairly a minor, modest income, especially as you can see from this chart. So we're going to have these programs around for a long time to come. OAS will shrink a little bit. CPP will increase a lot. And then what's important to understand is just how important these two programs are going to be for the average couple in retirement. So let's say a couple retiring now, someone like a Brett and Megan earning a bit more than they're earning, and that right now they have $600,000 in a registered retirement income fund, a RIF. So they can actually generate about $70,000 in income from all sources, including CPP and OAS, if they were retiring right now. And guess how much of that is going to be coming from CPP and OAS versus their own savings? Well, it's shown here in this chart. It shows if they were retiring now at age 63, the gray part of the bars is what they get from their own savings. And I'm assuming that they actually do what I suggest most people should do, which is to wait until age 70 to start their Canada Pension Plan. We won't get into that today because that is kind of off topic a little bit, but I actually do think this is the most effective and efficient way to get your retirement income. So if they did that, you can see from the gray bars that they're drawing down their RIF pretty fast in their 60s and early 70s. And then you see that after age 72 or so, the vast majority of their income is coming from CPP and OAS. So these are going to be two very significant programs for most of the people who are on this presentation today. Lesson number 3 is pay off your mortgage early. By early, I mean, I think the ideal is to pay it off just a little bit before your planned retirement date. Well, you might say, well, why don't I just bite the bullet and pay it all off by the time I hit age 45? Well, if you have that kind of income, then more power to you. We're going to show an example, the Brett and Megan example, to show that it's pretty hard for the vast majority of people to do that. I mean, they just don't have the spendable income, the disposable income to be able to pay it off that fast. It's better to pay it off, though, by retirement. And this way, you're actually going to need less income in retirement because one of the big things that actually draws down your spendable income during your working years is the amount of money that you have to pay in toward the mortgage. And then when the age-old question, should I be saving for retirement or should I be paying down the mortgage? I would be telling you that it doesn't really matter that much. Both of these are ways to increase your wealth, and both of them are effective in their own way. And I would say that either one of those, or maybe a combination of the both of them, is fine. You just have to make sure that enough money is going into the both of them to be able to give you that comfortable retirement. So lesson number 4 is smoothing out your spendable income. So there are 6 ways before retirement, well, 5 ways which can actually reduce your spendable income. So I think I mentioned that Brett and Megan, they had maybe $110,000 in income between the two of them. Now they have to pay income tax, we know that. There are some work-related expenses, commuting to work, if people are still going to an office versus working from home. But there'll be other work expenses as well. I include, for example, dues toward EI as a work expense, and Canada Pension Plan contributions would be a work expense, that kind of stuff. Child raising expenses, those are obvious and numerous. And one of the biggest ones is going to be daycare expenses for people who have young children. Mortgage payments, of course, I've talked about, that's income tax. And finally, actually saving for retirement. All these things reduce your spendable income. They reduce it more than you might realize. So let's kind of get onto that. Let's assume, for the sake of argument, that Brett and Megan are saving 12% a year toward retirement. And also, let's assume that they're paying off their mortgage, so that's fully paid off 5 years before they retire. So this chart shows a breakdown of where all their money goes. They're 100% of their dollars, and you see at the very top, 12% is going toward retirement saving. That's gone right off the bat. There's also the income tax that work-related expenses are next. There's the income tax, the mortgage payments, which, as they say, end 5 years by age 56, 57. And this is essentially what they have left. The black bars are their spendable income. So let's actually just isolate that. First of all, this is the same thing we just looked at, but this is done in terms of dollars. And this is today's dollars. So as I said, Brett and Megan today are earning about 110,000. I'm saying in 30 years' time, their combined earnings would be more like somewhere over 300,000 in current day dollars. So their real increase in earnings will be almost tripling over a 30-year period. And you might say, how is that possible? This is not only possible, it's probable. This is what happens to most people in their lifetime. Some fast trackers they'll be going up by more than 5 times what they were earning in their early 30s. It's all over the map. The 3 times is actually a fairly conservative estimate. So now here, all I'm doing on this chart is only isolating their spendable income before retirement. Just showing that's a net of income tax, net of retirement saving, everything else. And it should be a real eye-opener. It's showing that spendable income for Brett and Megan is really low in their early to mid 30s. The daycare period, when by the time they have 2 children, and Brett is 36, that is their low point. Then they start paying so they also have mortgage payments in that period as well. I'm assuming 10 years after they bought their first house, they trade up, and they only trade up once in their career. And so they have a second house out there. So they may start to have bigger mortgage payments starting in their early 40s. And then they're helping the kids pay for university by the time they're in their early 50s. So if they did all the things I just mentioned, including 12% going toward retirement saving, this shows what happens to their spendable income in real terms. So it goes from actually less than $25,000 when Brett's 36 to over $150,000, over $160,000 by the time Brett and Megan are in their late 50s, early 60s. So I'm saying that this is how it would look, but it doesn't work. The reason why it doesn't work is look what happens to their retirement income. I'm saying that this is how much retirement income they could get if they did that, based on all the assumptions I made. Their retirement income ends up being it's pretty hefty. It's around $90,000. So those are the green bars you see on this chart. However, it's pretty low compared with what their spendable income was in the last 5 years before they retired. So they're suffering a really major drop. If they were spending that money on vacations and on clubs and activities and everything else, they actually would come in for a real shock in retirement. So this isn't the way we ought to be saving for retirement, by putting in a flat 12% a year or 15% or whatever that flat percentage is. We got to do it a different way. And by the way, you might say, well, maybe we can just change the chart by having them save more than 12%. That way, those green bars would go up. The thing is, they wouldn't go up very fast. So let's say we made it more like 15%. Yeah, it would go up to nudging just a little over $100,000. There would still be a big drop from their earnings in the last 5 years, and on top of that, their spendable income would almost disappear when in their 30s. So that doesn't work. They can't. So bottom line is, you just can't expect to be saving a flat percentage every year of your working life. So lesson 5 would be, based on all that, would be apply the rule of 30. What I mean by rule of 30 is your retirement saving, in which we were talking about 12%, but it'll change, plus your mortgage payments, plus your special expenses. And by special expenses, I mean things which you really can't avoid, things which are pretty short-term in nature. They won't be there all the time. Special expenses, when you combine those 3 things, they should not be any more than 30%. The percentage is not important. It's there just so I can have a title for the book. And that's why I'm calling it rule of 30. It could be rule of 35. The important thing is that the combination of those 3 things should be more or less a constant. Whatever constant works best for you, whether it's 30 or 35%, that's what it should be. So let's see what happens if we do that. If we have spendable income under the rule of 30, so now that's what we've done. We've actually applied the 30% to Brett and Megan. So this is the same chart for them now, but what they've done is they're contributing a lot less in their early 30s. And as a result, they have a lot more spendable income than they had before. It's still low because their earnings are lower and because they still have a lot of expenses, but they're not struggling as much because they're not putting in very much money toward retirement saving. I believe in the book, I had them saving somewhere between 0 and 5% in their early to mid 30s. Then you see that their earnings become pretty significant by the time they get into their 40s, even though they're making mortgage payments toward a new house, and then by their 50s, their income, their spendable income is still rising. Remember, the black bars are only spendable income, and it's topping out at around $120,000 in real terms. So they don't have spendable income as high in their late 50s as they had before, but now it's sustainable. Because they did this, they saved in this manner. By the way, it means that they end up having to save about 25% of their income in their late 50s, early 60s. And you might say, how can they do that? Well, this chart shows how they can do that. They had so much spendable income at that point in time that even if they do save a much higher percentage, they're not suffering. They still have more spendable income than they ever had at any point in their life. And then it shows that the green bars, once again, are retirement income. It shows now that it's pretty comparable. Yeah, it's off by a little bit here, but essentially they can now sustain that spendable income they had in their late 50s for the rest of their life by following this rule of 30. So now the next revelation, though, is that the rule of 30 is only an approximation. So you have to know when to switch over. I say an approximation. I'm saying you need to know roughly how much money you can save in your 30s. And I'm saying you can't kill yourself by trying to save 12 or 15% or even 10%. So you have to save less. But then you really have to start saving more in your 40s, and you should be able to, based on the rule of 30. And you have to be saving even more again by the time you hit your early 50s. But by the time you hit your mid 50s, let's say it's still a few years to go before you retire, you ought to be replacing it by a retirement calculator. And that's because saving for retirement, it should not be a doomsday machine. It shouldn't be where you save either a flat percentage or rule of 30% until the point of retirement. Then you say, well, okay, let's see how much I can now buy. you ought to be going into retirement with your eyes open. You ought to know how much income you can expect in retirement. So a retirement calculator will help. I'm offering one for free and with no obligation and with no sales calls or anything. It's simply a part of the book, Retirement Income for Life. It's like an adjunct to it. I needed to have a retirement calculator. Otherwise, I couldn't tell people how much money they could income they could expect in retirement. You can find this under the site shown here on the chart, perk.ecm.lifeworks.com. So at that point in time, you're going to have whatever money you've got. You will have earned your investment income. You will have made contributions to various vehicles and all that. And so you'll know where you stand at that point. You plunk all this information into the calculator, and then it's going to show you how much income you can expect in retirement, assuming you keep on saving at a certain rate, and depending upon whatever your retirement age is going to be. Then lesson 7, this is the final one, is save smartly. Sorry, I'm picking up American terms. That's what happens when you spend time in Palm Springs. Save smartly. First of all, keep your investment fees low. Some of you might be in mutual funds and you might say, well, I don't have investment fees. You might be shocked to find out that you're actually paying over 2% a year in mutual funds, in some mutual funds, and you can't afford to do that. You want to keep your investment fees low, you can do that. You can go with a robo-advisor. You can go with someone like Questrade. I'm not offering Questrade a free commercial here. But they are a good option to be considering. So keep your investment fees low and throughout your career. It makes a big difference in how much you're saving for retirement, and also a big difference in how much income you can have in retirement. Second rule is to follow what I call a TDF, that's target date fund approach to your investments. In my example, I had Brett and Megan investing in a 60-40 asset mix, 60% equities and stocks and 40% bonds. In actual fact, I don't think that's the way people ought to be saving for retirement. I think if you're in your 30s, or certainly if you're in your 20s, and if you're in your early to mid 30s, you should have 100% of your money in stocks at that point in time, because you have plenty of time to weather the ups and downs, and there will be ups and downs. We had a big down in 2022, but you have a lot of time to make up for it. And believe me, based on any historic period, you will be better off having had 100% in stocks if you're looking at a long investment horizon, which is what a 30-year-old has. Now, once you're in your 40s, though, you have to start investing a bit less in equities. For example, the 100% might actually drop to 80 or 75%. And by the time you hit your early 50s, it might drop again to 70 or 65%. Now, if you saw my chart in the Globe and Mail, I think it was a couple of weeks ago, it showed what would happen if you had, at the point of retirement, if you had a 60-40 mix versus 50-50. And people often figure, well, to be conservative, I should really have a 50-50 mix by the time I hit 65. I showed that actually that isn't really the case. It looks like a 60-40 mix would have been more effective in virtually any past period going back to the 1930s than a 50-50 mix. And you would never have really suffered. There was one period when you would have done 0.2% better in a 50-50 mix. Otherwise, it never actually beat 60-40. But bottom line, you ought to be thinking of 100% in equities when you're in your 30s, going up to 60-40 by the time you hit your 60s. Third thing to do to save smartly is you ought to be saving in TFSAs, tax-free savings accounts, when your income is low. And if you can max out on your TFSAs, that would be great. And you ought to be saving in RRSPs when your income is higher. So Brett and Megan, if they're in a fairly low income tax bracket currently, maybe they ought to be putting most of their money into a TFSA. Later on, as their earnings rise in real terms and they're in a higher tax bracket, they should put money into RRSPs. And finally, this is actually breaking my own rule. Max out on employer matching contributions in group RSPs or DC pension plans. Some of you will be in a plan where if you put, you actually have a choice of how much money you want to contribute toward your your DC pension plan, your defined contribution pension plan. Maybe that percentage is say 4%. If you put in 1%, they'll match you 1%. If you put in 4%, they'll match you 4%. I'm saying max out, even if it means going over your rule of 30. Do that because this is free money. Your employer is giving you money. There is no catch. If you're wondering, well, what's the catch? Well, maybe I can do better just on my own. You can't do better. No, you have to max out on those employer matching contributions any which way you can, even if it means having to borrow to do it, at least for a short period of time. So those are my rules for saving smartly, and that'll reduce somewhat how much money you do have to save for retirement and increase somewhat how much income you can expect. So very quickly, how will the future be different from the past? Well, we've gone through this. We've shown CPP pensions will be larger because the program is expanding. OAS pensions will be a little less important because it's shrinking in real terms compared to the average wage. This is something I haven't talked about. Inflation could be a problem. When I wrote my last two books, Retirement Income for Life and Rule of 30, I thought we had pretty much tackled inflation and wrestled it to the ground. We hadn't seen inflation higher than roughly 2% ever since the early 1990s. So we went almost 30 years with low inflation. And I thought, the Bank of Canada is doing a good job. We won't have to worry about this anymore. What I didn't count on was a black swan event, which is what the COVID pandemic has been. And inflation spiked the way it did last year because of the shortages induced by the COVID pandemic. And of course, we saw inflation jump over 8%. We got back to levels we haven't seen in 30 years or more. And that was a problem. Now that might be behind us now. Inflation is going down even on a monthly basis right now. We might even be back to 2% inflation in a year's time or 2 years. However, what I've learned is that it could always rear its ugly head again. We don't know what's going to happen in 10 years or 20 years time. We don't know what is going to be causing inflation again, but it can arise again. As long as governments are prepared to spend a lot more money than they earn, and certainly we've seen that in the last few years, it's always a possibility that we can see another spike in inflation. And what that means is you ought to be maxing out on things like CPP and OAS, any kind of pension that's inflation protected. And otherwise, the same lessons will apply in the future. So in spite of all the likely changes and things that will happen in the future, the rule of 30, the principle still applies that, the combination of how much you put into mortgage payments, daycare expenses, and saving for retirement should be more or less the same percentage every year, whether that be 30 or 35% or whatever it is for you. You still want to pay off your mortgage a little sooner, as I mentioned. And that essentially is the end of my presentation. I'll be happy to take a few questions.
Awesome. Thank you so much, Fred. We really appreciate the presentation. I know I learned a lot, and I hope our customers and guests learned a lot today as well. So I think we'll kick off with a couple of questions for Fred. I guess the first question here from earlier in the presentation from an attendee was the chart that you showed showing the real return mix over the last 40 years. Are you able to elaborate if those were the S&P 500 numbers, if those were maybe combined between the Canadian and American markets, or where those kind of returns came
elaborate on that. Yes, what I assumed in that was that the 60% that was going into stocks was split 50-50 between the S&P 500 index, and that includes dividends, by the way, and the other 50% was invested in the S&P TSX, the Canadian stock market, once again including dividends. So, and then the other 40% was in the Universe Bond Fund. So that's how I did that, and that would be rebalanced every year. So as the percentages would drift away from 60-40, they would put it back to 60-40 on an annual basis.
Okay, perfect. Thank you so much for explaining that for us. So we had a couple of questions about PERC that we're going to get to in a second. I just want to scroll through and see if there was any general Questrade related ones here. Unfortunately, we're not going to be able to answer very specific personal questions about investment advice specifically during today's event, so it's going to be a little bit more general. There we go. We got a question about ETFs, whether or not they're a good investment strategy. While I can't comment on any specific ETFs, also known as exchange traded funds, can be a fantastic alternative to mutual funds or other type of investments with high fees. If you're not familiar with them, ETFs are basically a basket of assets that can contain stocks, bonds, real estate, fixed income products. Basically, if it's out there, there's an ETF for it. So ETFs are always a great investment strategy if you're saving on fees. All right, and then we'll move into a couple of these perk questions here. So it looks like there's a question here. If there's any way to export tabular data from the perk model. So I guess this might be an attendee who's looking to take some of the data from their perk model and put it into an Excel spreadsheet, for example.
I haven't allowed for that so far. I really hadn't thought about that as being a possibility. That sounds like an interesting thing to look at as a possibility. But I remember, by the way, that the perk only works it's actually targeted at people between ages 50 and 80. So you have to be at least 50 years old to use it, because it's assuming that you're actually getting close to retirement, as opposed to, it's not really a tool for 30 or 40-year-olds.
Okay, perfect. Thank you for clarifying that. So maybe we'll see that in the future then, hopefully.
Right.
All right, we've got one more perk question here, and then we'll move on to a few more. So this guest here mentioned they've used perk for the last 2 year ends. It's fantastic. They just have a question, since their spouse has a defined benefit pension and an annuity is not part of their plan. So is there any way to use the perk model without following the improvement of buying an annuity to kind of calculate the spendable amounts?
I don't want to turn this into a commercial, but here's what I've done in the last couple of years. So the second edition of Retirement Income for Life was all based on using perk the way it is, and including the annuity. I've actually started having second thoughts about annuities myself at this point. They're still not a bad investment, but they aren't like such a wonderful, really greatly effective investment in every case. It's also less of a good investment than it used to be because of the fact that it's not indexed to inflation, and so you run the risk of seeing your annuity really drop in value if inflation does kick up again at some point in the future. So what I've done is with my third edition to Retirement Income for Life, which is coming out this fall, I'm also introducing the idea that you can optimize your solution. So people don't want an annuity, then they can do that. If they find that it's actually better for them to only wait until age 67 to get their CPP instead of age 70, they can do that, and so on. It does mean manual intervention. So I'm going to be allowing for that. Here's the commercial part. That'll take up real human time. So there will have to be a fee. I'm hoping a very modest fee attached to it, but that option will be available. Actually, it's going to be available before the fall, but that is something that people can stay attuned to.
Oh, awesome. Something to watch out for then. Fantastic. Thank you so much, Fred. We just had one quick question about the rule of 30, pretty general one. Is this pre-tax or post-tax?
It's pre-tax. So it's pre-tax. So actually, yeah. So for example, I actually do address this in the book. And I just don't make quite that much of a fine point to it. The thing is, we can't look at the 30% as being a hard and fast and always be the right number, whether it should be 28 or 30 or 32. I just mean in general, we ought to be seeing about the same amount going into all those vehicles. So certainly putting in 50% into an RRSP versus 50% into a mortgage is a very different kind of a thing. I would say people ought to look at these as just being pre-tax.
Perfect. Thank you so much. Appreciate the insight there. So just a couple of questions here about whether or not we have a recording of today's session. Good news, we do. So if you had to leave early, if you joined a couple of minutes late, we will be emailing that around sometime next week. So as long as you registered for the event and you're here, we'll send that around so you can rewatch at your own convenience. Got a pretty simple question here. Can you invest if you're retired, or should you focus more on saving? So I guess this is a question for you, Fred. What do you think?
If you're retired?
Should you continue investing, or should you more focus to saving?
Well, I generally think that saving ends at the point of retirement. I mean, retirement is the time when, instead of trying to build up your asset base, your nest egg further, it's the time when you start thinking about drawing down your nest egg. Having said that, I still think people ought to be thinking about, and this is really outside it's more like from the Retirement Income for Life book, but they ought to be thinking about putting a few percentage, maybe 3 or 4 or 5% a year of their retirement income into a reserve fund. The idea being that you never know what kind of spending shocks you're going to have in retirement, like your roof caves in, you end up having a disability that requires all kinds of additional personal support care. And so on. So you always ought to have a bit of a reserve fund to build up for that. So you are kind of still saving in retirement, but it should be a fairly small percentage. And you really do have to start thinking about drawing down your savings in general, like I showed for Brett and Megan.
Definitely. Yeah, it's you've been waiting all those years to enjoy the fruits of your labor. Might as well spend some of it, but doesn't hurt.
And that's hard to do. I mean, if you only been seeing your nest egg growing, it's really hard to see it start shrinking. But that's got to happen at some point, because otherwise, what's the point of saving all that money in the first place?
It's a very good point. Thank you so much, Fred. So we'll do maybe 1 or 2 more questions here before we'll slowly wrap up for today, just to respect everyone's time. What are your thoughts on the robo-advisor concept, Fred? Do you have any quick ideas, any thoughts, maybe advice?
Yeah, I do. I do. I feel that I've really stressed in this presentation how important it is to get your fees down. And in all my illustrations, I show that on the before picture, fees are about 1.8%, but they can be even higher than that on an annual basis. And I think you got to get them down to around the 0.6% level. If you were smart enough not smart enough, if you were educated enough in financial matters to do it yourself, then great. Some people can do it and some people can't. Maybe everyone can read a few books, I guess, at the point of retirement, but that's hard to do. And you always have to wonder, well, if there's something you don't know that you should know and something you're missing if you're not an expert. Robo-advisor is like a great solution. I was really happy that came along, because it's a way to get your fees down to like 0.6%, roughly around that level. You can maybe refine that a little bit for me, John. But it's a way to get it down around that level, the level that I think you ought to be getting it down to, and they'll manage your account based on with investments that would give you that kind of level with the kind of asset mix that's appropriate for you. So I think it's a good idea.
Thank you so much, Fred. And just to expand on that a little bit from some of Questrade's offering for those in the audience that aren't familiar with our Quest Wealth portfolio wealth management service, our management fees actually start at 0.25%. So basically 1/5 to 1/10 of what some of our competitors in the big banks charge. And if you're investing over $100,000, that fee actually drops to 0.2%. So I believe in the industry, we are the cheapest wealth managed robo-advisor at the moment. All right, we'll do 1 more question before we wrap things up here today. Let's see here. There are so many coming in. I'm so sorry, everyone. We won't have time to get through all 40 remaining today. But let me try to pick a great one here that's going to be relevant for the whole audience. There you go. Here's a quick, simple one here. Does the rule of 30 still apply for single individuals? So those that don't have a partner, maybe don't plan on having kids. Could you maybe elaborate a little bit on that, Fred, or maybe some alternative strategies?
It applies to everybody. Once again, I'll stress that the actual 30 might be a slightly different number, but the idea that you want to smooth out your spendable income as much as possible, and the way you do that is that you take all your special expenses, your mortgage payments, and your retirement saving, and make it a constant percentage. That way, your spendable income ends up being a more stable number. You don't want to see spendable income go way down in some years, because it just means you're struggling and you're suffering financially, and then go way up in other years to a level that you can't sustain. You want to see it being a more stable number. So that applies to everybody.
Awesome. Thank you so much for the insightful answer. And once again, thank you so much for the presentation. I see a lot of comments here from the audience. Big fans of your book, big fans of the presentation in general today. So really appreciate having you on today.
It's been my pleasure. Thank you.
Thanks again, everyone.